All right, dear students, now we are heading towards the IAS 23, which is the borrowing cost. And when we were doing the IAS 16, and in the initial measurement, we discussed that the initially asset should be recorded at cost. And there were few components, if you remember. The first thing was the purchase price, less rebates, purchase price, less duties, less rebates, and then any directly attributable cost to bring the asset in the working condition. Any directly attributable cost to bring the asset in the working condition. And there was a third thing over there as well, which was the borrowing cost. Now, what is the borrowing cost? Borrowing cost is the cost associated with the borrowing. And what is borrowing? When you are borrowing the funds. Now, what does this has to do with the cost of the asset? If you're constructing an asset and for the construction, you are taking the loans. And obviously, when you're taking a loan, you will be paying the interest cost. Now, that interest cost should be capitalized because that is a relevant cost. That is a direct cost. You can avoid that cost if you are not constructing an asset. For example, I'm constructing a warehouse for my business. And for the construction of the warehouse, I need a loan from the bank. And when I'm getting a loan from the bank, I need to pay the interest cost. So that means this interest cost, which I am bearing, which I am giving, which I'm paying, is due to the asset which I'm constructing. If I'm not constructing any warehouse, then there is no need of taking the loans and I can avoid that borrowing cost. So that means this borrowing cost is particularly directly related to the asset. And when something is directly related to the asset, then the standard says you are going to capitalize it. So this is the idea behind the IAS 23, that if you are constructing an asset, now which asset? And there is a specific term for that. So IAS 23 requires that the borrowing cost, now this borrowing cost is the interest cost associated with the acquisition. That means when you're purchasing that asset, construction or production of a qualifying asset are be capitalized as part of the cost of the asset, because you can avoid that cost if you are not constructing that asset. If you can avoid that cost if you're not acquiring that asset. You can avoid that cost if you're not producing that asset. So that means you are taking the loan just for this asset, so that interest cost should be capitalized. Now, remember one thing from the very start, that when I say that interest cost should be capitalized, then that interest cost should be related to the construction period. This is something very, very important to understand. Like I can take a loan for example, 2 years. Let's assume I took the loan for 2 years. Let me give an example so it is more clear. I took a loan of $2 million for 2 years. Now this is a maturity. I need to pay it back within 2 years. And the interest rate is, let's assume 10%. And it took me, let's assume 18 months to construct an asset. Now, when you are calculating the borrowing cost, so first of all, what you'll be doing, 2 million multiplied by the 10%. This will give you the interest cost of the first year, the whole 1 year. And then you have this 2 million multiplied by the 10%. Now, I took the loan for 2 years. The interest cost belongs to the 2 years, but not all the interest cost should be capitalized. It should be related to the construction period. Now, for example, my construction was related to 18 months, and the next year I'm going to take on, because 12 months have already been capitalized. So I'm going to take only 6 months further to make it 18 months. So that means in total, the 18 months interest cost should be capitalized, not the 24 months. So this is something you need to remember from the very start, that we are going to take the interest cost which is relevant to the construction period and nothing else. So what is the borrowing cost? Interest and other cost. Now interest and other cost means which is relevant to the interest. For example, when you're taking the loans, there may be some cost associated with arranging the loans. That is classified as the borrowing cost as well. For example, you're taking the loans in the foreign currency, and if there's a movement in the foreign currency due to the exchange rates, so if that exchange gain or loss is also attached with this borrowing cost. So for example, if you're taking the loans and you're giving the premiums to have the loans, that premiums which you are paying should be regarded as the borrowing cost as well. So borrowing cost doesn't mean the interest only on the loans. It includes the premiums and the discount. It also includes the ancillary cost. It also includes the cost which is associated with arranging the loans. It also includes the exchange differences. For example, if you have the foreign currency loans and there's a movement in the foreign currency, so that will affect your interest cost as well. That is regarded as the borrowing cost as well. And then you have the qualifying asset. Qualifying asset. The IAS 23 says that if you are taking the loans to construct the qualifying asset, only the qualifying asset, then the interest cost should be capitalized. For example, if I am buying any inventory which is a ready-made inventory, and that means I cannot capitalize the interest cost, because IAS 23 specifically says that you can only capitalize the cost associated with the qualifying asset. Now, what does the qualifying asset mean? An asset that necessarily takes a substantial period of time to get ready for intended use of the same. Now, we are living in the 21st century and things are getting more modern nowadays. Like I was just looking at some reports from the China. They have built a multiple floor building within days. They made the hospital overnight. So there's no definition of the substantial period nowadays. Things are getting more advanced and advanced nowadays. So what does this substantial period mean? 6 months, 8 months, 10 months, 12 months? No, there's no definition of the substantial period of time. So the substantial period simply means that you should know how much time your asset is going to take for the construction. You should know the time. And there should be no unusual delays within that. Like, for example, you have done some construction, then there's a gap of, for example, 6 months. Then you made some construction, then there's a gap for a few months. There should be no unusual delays within that. So the time should be clear, because, for example, if I want to construct a warehouse and it is going to take, let's assume 1.5 years. So I might go to the bank and will be telling them to give me a loan for 2 years. So for example, if my construction is going to take 6 months, then I'm going to get the loan of the maximum 1 year. Why I would be taking the loans for 2 years if my construction is taking 6 months? So that means it does make sense that you should know how much time your asset is going to take for getting ready for its intended use or sale, because accordingly you will be getting the loans from the bank. And it also matters a lot for the years decides the interest rate. Like, for example, it's a short-term loan, it will be having a different interest rate. If it's a long-term loan, it will be having a different interest rate. So it is quite important to know how much time the asset will be taking to get ready for intended use or sale. So the idea behind the IAS 23 is that if you are taking a loan to construct a qualifying asset, then interest cost should be capitalized. But make sure that interest cost we are talking about should be relevant to the construction period. Other than that, that should be expensed out. For example, if I've taken the 2-year loan, I've given the example over here, and I only it only took 18 months to construct an asset, then the cost associated with 18 months should be capitalized. The other 6 months should be expensed out. So this thing is very important for the IAS 23. Now this explains what is the borrowing cost. I've already explained to you. It includes interest cost, premiums, arrangement of the borrowing cost, and then there are exchange differences. Then we have what is the qualifying asset. It can be anything. Let's assume inventory. Now when we say inventory, mostly the small things comes to our mind. For example, a shopkeeper selling the snacks, for example, mobile phones, for example, laptops. Like, few things come to in our mind when we say inventory. Now it can be anything. For example, if you are constructing the houses to sell it, the intention to sell it. Like, for example, I have a business of the construction. I construct the house and then I sell it. Then it should be regarded as the inventory. Now, if I'm constructing a house and I've taken the loan for that, now that represents the inventory. In that case, the interest should be capitalized. It is a qualifying asset. Similarly, when you're building a manufacturing plants for the company, power generation facilities, nowadays we have the bio plants, the solar plants nowadays. Intangible asset, for example, it can be, for example, you're making a software for yourself, a big website that involves a lot of funds, and you have taken a loan for that. Similarly, the investment properties. So it can be anything that takes substantial time to get ready for intended user sale. So financial assets and inventories that are manufactured or otherwise produced over a short period of time, like for example, if you are selling the snacks or the fizzy drinks, that is your inventory as well, but you are not going to capitalize the interest cost pertaining to that. And then we similarly, the ready-made assets, like assets that are ready for the intended use when you buy it, ready-made assets that should not be regarded as the qualifying asset as well. Now we have the borrowing cost eligible for the capitalization. And I told you that if you want to see which cost to be capitalized, then see that this cost can be avoided. It would have been avoided if you were not constructing the asset. Let's assume I'm constructing a warehouse and I need a loan for that. So if I'm not constructing the warehouse, I do not have any need for taking the loans. That means I'm taking the loan specifically for constructing the warehouse. That is a direct cost, and that interest cost should be capitalized. So this is what IAS 33 says, that these are the borrowing costs that would have been avoided had the expenditure on the qualifying asset not been made. This is obviously straightforward, where funds have been borrowed for financing one particular asset. That give rise to the concept of the specific borrowing and the general borrowings. Now, for example, if you're taking a loan to construct a specific asset, that is known as the specific borrowing. But for example, if you have multiple loans in place and you are constructing multiple assets from them, then that is known as the general borrowing. For example, I took a loan from Bank A, Bank B, and Bank C. These are the banks. And I've taken loans from these three banks, different amount and a different interest rate. And I'm constructing X, Y, Z assets, three types of assets from these loans. Now, this is not the specific borrowing. This is the general borrowing. Now, why we are studying that? What is the problem? What is the issue associated with the general borrowing? The issue associated with the general borrowing is that you may have the multiple interest rates. For example, you took a loan from the Bank A, let's assume $1 million, and they give you the loan on the 10% interest rate. You took a loan from Bank B, the amount is $2 million, and they give you the loan on 9%. You took a loan from Bank C, the amount is $3 million, and let's assume they gave you the loan of 8%. And then you're constructing an asset X, then constructing Y, then Z, and the mixed funds are used. For example, X involves $1.5 million. Now, which interest rate you will be using for the calculation of the borrowing cost? Because this is an issue, because you're using 1 million, let's assume, from the 10%, and then 0.5 million maybe from the 8%, maybe from the 9%. So when you have the multiple borrowings and you are financing wide range of assets from that borrowing, then the standard says you need to calculate the weighted average cost of capital, which is known as the WACC, And when you have the specific borrowings that involves a specific rate, then it makes life easier to just take the rate and then you calculate the borrowing cost. But there's one point written over here that is very important to understand. So the borrowing cost which may be capitalized are those actually incurred. And remember that principle, it should be related to the construction period, less any investment income on temporary investments of the borrowing. In order to explain this concept, let's take an example. For example, you took a loan from the bank for $5 million, and you need to pay it back, let's assume, in 2 years. Now, initially, you were in need of $3 million for the construction. You started spending $3 million on the construction, and $2 million was surplus. Now, if you're keeping it in the bank, then you're losing the money, because we know the concept of the time value of money as well. So you do not need it, let's assume, for 6 months. So why not investing this $2 million for 6 months? So you're going to, you're going to invest this loan for 6 months. Let's assume at the percentage 4% per annum. Now, when you're calculating the borrowing cost, you will be subtracting this investment income, which is the temporary investment, which is the earnings you have made on the temporary investment. So whatever your borrowing cost is, you're going to deduct the investment income of these 6 months. Let's assume 2 million multiplied by 4%, multiplied by 6 by 12. This amount, whatever you get, should be deducted from the borrowing cost of the construction period. And this temporary investment should be related to the construction period as well. Now, let's assume I invested for 8 months. And the construction was only for 6 months. So I'm not going to take full 8 months and then subtract it. We are going to take the period which belongs to the construction period only. And then we are going to deduct that amount. We have a few examples coming up next. So just remember the concept that you're going to take the borrowing cost and you are going to deduct the investment income, which is the return on the temporary investment you have made. Now, how to calculate this weighted average cost of capital? We have the questions in the exam related to this as well. If a company had a 10 million 6% loan and a 2 million 8% loan, the weighted average cost of capital, how you're going to calculate it? Now, when you take the 10 million and multiply it by 6%, it gives you the interest cost. Plus, when you multiply 2 million and you multiply 8%, it gives you the interest cost related to the 2 million. So 10 million to 6%, then it gives you the interest cost of that 10 million. 2 million into 8%, it gives you the interest cost related to 2 million. And when you divide it by the total financing, which is the 12 million, it gives you the average rate of 6.33%. So basically what you're doing from the formula, understand it in substance, the numerator, you know the maths, this is known as the numerator. This numerator gives you the total interest. This denominator is the total finance. So when you compare the total interest with the total finance, it gives you the average rate of 6.33%. And in the exam, if you are going to check it, whether you have computed it correctly, you need to see this average rate should be between these two interest rates. Now, sometimes students are calculating and they tell me, sir, 9%. Now, how it is possible that the average of 6 and 8 becomes 9? The average of 6 and 8 should be something between 6 and 8. So this is the indicator that if something is coming between 6 and 8, you have computed the interest rate back correctly. Now, how this interest rate which we have calculated is going to benefit us in terms of calculating the borrowing cost is simply, let's assume we were having the total finance of 12 million. Let's assume they have used $9 million from it. So we are going to take 9 million, which is the amount they used in the construction. You multiply it by 6.33%, and this is the per annum rate. Let's assume the construction continued for 8 months. This is the borrowing cost, which should be capitalized. So the WACC, which is the weighted average cost of capital, is when you have the multiple loans in place, which carries the different interest rate, and you're financing a range of assets for that from that. So you need to take the weighted average cost of capital in order to calculate the borrowing cost. So you take the amount which has been spent on the construction of the asset, you multiply it by the interest rate, and then you multiply it by the months by 12, and then you get the borrowing cost, which is the amount to be capitalized. And now we have the commencement of the capitalization. Again, this is something very important to understand. You can say this is an accounting issue, that when you are going to start the capitalization, because sometimes, sometimes you commence your construction, that construction is started, but you have not received the loan yet. Sometimes it is possible that when you started your construction, you believed that you are having enough loans to finance your asset. And then later you realize that you need a loan. So later you went to have a loan from the bank. So from which date you are going to capitalize the borrowing cost? Because your construction may start earlier, or it is possible that you receive the loans earlier and the construction started later. So what is the best time defined by the IAS 23 to commence the capitalization? So capitalization of borrowing costs should commence when all of the following conditions are met. The first thing is expenditure for the asset is being incurred. Now, what is the expenditure for the asset is being incurred? That means, for example, you have acquired the site. Borrowing costs are being incurred. That means you have taken the loan and the interest has started to accrue. And the third thing, activities that are necessary to prepare the asset for its intended use or sale are in progress. That means the construction has already started. So all of these, for example, if you took the loan and construction has not started, then you cannot capitalize the borrowing cost. If the construction has started and you didn't receive the loans, that you cannot capitalize. So that means all of that should be met in order to start the capitalization. You have received the loans and you have started the construction as well. Now we have an example to just have a grip on this concept which we have studied. Grimtown took a 10 million 6% loan on 1st January 2001 to build a new football stadium. So 10 million loan for interest rate is 6%. This is a specific borrowing. It's not the multiple loans. It's a single loan having a single interest rate, specific interest rate. So it's a specific borrowing. So they took the loan on 1st January. Not all the funds were immediately required. So the 2 million was invested in 3% bonds until 30th June 2001. And I told you that both the borrowing cost, interest cost, and the temporary investment, which is the return you will be getting on that, should be related to the construction period. Now they invested from 1st January to 30th June, and now we need to see the construction period. The construction of the stadium began on 1st February 2001 and was completed on 31st December 2001. So how many months these are? These are 11 months. Calculate the amount of the interest to be capitalized in respect of the football stadium as at 31st December 2001. So first of all, you're going to take, okay, 10 million is the amount which you have taken, multiply by a 6%. Now this 6% is per annum. We need to see how many months we're going to take. So it's 1st February to 31st December. These are the 11 months, 11 by 12. And then you need to deduct the temporary investment which you have made. So how much that is? 2 million multiplied by 3%, which is the return rate of return. Multiply by how many months? Now this invested from 1st January to 30 June, but again, construction started from 1st February. So the first month is not relevant because we are going to take the investment income, which is related to the construction period. So construction period is from 1st February to 30th June. That means 5 by 12. So on the next page, you can see the solution. Interest 10 million multiplied by 6% multiplied by the 11 by 12, you get 5,50,000. And then you deduct the investment income, which is made during the construction period. 2 million into 3%, 5 by 12, because we're not taking January into account. So you deduct the 25,000 from it, and this 5,25,000 is the amount which is to be capitalized. So the 1 month in which the construction was not started should be expensed out. This is the finance cost. And that 1 million 1 month in which you earned the interest income, investment income, should be recorded as the income because that is even not taken in the calculation of the borrowing cost. Now we have the suspension of the capitalization, and you can call it as haltage as well. The stoppage, the temporary stoppage. If an active development is interrupted by any extended periods, and we usually take months into account, like for example, if it is about 1 or 2 days, that is something which you can ignore. We're talking about the months, extended periods. Capitalization of borrowing costs should be suspended for those periods. It can be any reason. For example, there's a rainy season, and due to that rainy 1 month season, you are not doing the construction. It can be, for example, any event, days, Easter, Christmas, Ramadan, Eid holidays. It can be anything. So if active development is interrupted for any extended periods, so let's assume it can be, nowadays, the lockdown as well. So if active development is interrupted for any extended periods, capitalization of that period should not be, the borrowing cost of that period should not be capitalized. And it should be a temporary delay, and it should be something which, for example, you're going to stop the construction for a month or 2. And it should not be unusual delays in which you are uncertain for how many months the haltage or the stoppage will continue. In that case, you're going to discontinue the capitalization. For example, there was someone who was doing the construction on the land, and then someone came and claimed to have the legal ownership of the land, and he went to the court and took the stay order. And the court says that until the case is resolved, you cannot do the further construction. Now, you're not aware when the case will be resolved. So if the stoppage is for undefined period, in that case, you are going to discontinue the capitalization. And in this slide, we are talking about the temporary haltage, which you are aware of. And there's one more thing which is technical and pertaining to this point, is suspension of the capitalization of borrowing cost is not necessary for temporary delays, such as a day or 2, or for periods where substantial technical or administrative work is taking place. Now, for example, you're doing the construction, and now the team is there to have a survey whether you are doing the construction well and whether everything is going fine. Now, even that survey is part of the construction as well. So don't think that the construction has stopped and you are not going to capitalize those days, because that survey, that technical work, that administrative work is part of the construction as well. In that case, you are going to ignore that thing. Now we have the cessation of the capitalization. The cessation of the capitalization is when you're going to cease the capitalization. After that, there will be no capitalization. So the standard says that when the asset is available for use or sale, that means the physical construction of the asset is completed. I'm not talking about the day which you have started using it, or the day which you have started selling it. That is not relevant. We are talking about the day in which the asset was completed and now it is ready for use or sale. And I'm talking about the major construction. Because, for example, if the minor modifications are still outstanding, then that does not constitute that you are going to still continue the cessation. For example, you did the construction, everything is completed. Now you need to have some sort of interior designing to, enhance the beauty of your construction. Now, that beauty can continue for forever. You may have anything going for years. We're not talking about those interior designing and stuff like that, because that can continue for years. We're talking about the major construction. If that has been completed, then you're going to cease your capitalization. That means after that, there will be no further capitalization. There's another point, which is sometimes we have assets which are completed in piecemeal, completed in parts. For example, you're going to make a hospital. And first of all, you build the emergency block. This is the emergency block. First of all, this emergency block has been completed, or it can be a university. For example, the management sciences section has been completed. Now there's the work going on engineering block. Now the engineering block has been completed. Now there's a medical sciences the block which is still in the construction. Similar in the hospital, there can be emergency block, there can be general checkup, the surgery wards, things like that. So if you're constructing the asset within the piecemeal, within the parts of the stages, so you're going to cease the capitalization of one unit when it is completed, then the next, if the second is completed, then the third, and so on. So the asset may be completed in parts or stages, where each part can be used while construction is still taking place on the other part. For example, the emergency block has completed and you have started taking the emergency cases. The surgery ward is still in the progress, so you're not doing the surgeries. The capitalization of the borrowing cost should cease for each part as it is completed. The example can be the business parks, the hospitals, and the medical colleges, or other universities, things like that. Now we have an example. On 1st January 20X5, Sensco began to construct a supermarket which had an estimated useful life of 40 years. It purchased a leasehold interest in the site for 25 million. Leasehold interest site, that means the land. The construction of the building cost 9 million. And the fixture and the fittings cost 6 million. So these three are relevant costs, should be capitalized. 25 million plus 9 million plus 6 million. The construction of the supermarket was completed on 30th September 20X5, and it was brought into use on 1st January 20X6. Sensco borrowed 40 million on 1st January 20X5 in order to finance this project. 40 million on 1st January 20X5, and the same day the construction was started, so you can start the capitalization from the 1st January. The loan carried 10% per annum and it was repaid on 30th June 20X6. Now we are not taking into account when it was being repaid. We are concerned when the construction was completed. So the construction was completed on 30th September. So we are going to take from 1st January to 30th September. That means the 9 months. So what we are going to do, we take the land, which is the leasehold interest, 25,000. We take the building, which is 9,000. We take the fittings, 6,000, and then the borrowing cost, which is the direct cost as well. So 40,000 was the amount of loan, 10% was the interest rate, and construction continued for 9 months. So the total cost to be capitalized is 43,000. All right, now we have another example, which is Murphy commences building a new head office on 1st May 2007. And remember, in these type of questions, dates are very important. The project is anticipated to cost 400,000, which Murphy company believes can be financed from the reserves. I think they are rich enough to build the head office. So they already have the 400,000. On 1st October, it becomes apparent that the loan is required to finance the project. Now you see, they started the construction earlier, and later they realized that they need the loan. So that is why the criteria is that you need to capitalize from where you started your construction, and the loan has been received as well. Now, the construction started earlier and you took the loan later. So that means the later date is relevant for the capitalization. On 1st October, it becomes apparent that a loan is required to finance the project, and 350 is advanced from the Northern Bank at a rate of 4%. So they borrowed 350,000 for construction, and the rate is 4%. Half of this is invested in an interest-bearing account at the rate of 2.5% until it is required on 1st May 20X8. So they invested the half amount, which is 1,75,000. Half is 1,75,000. Half of that is invested. Fine. At 2.5% for how many months? From 1st October to 1st May. Building commences throughout the year ended 31st December. Although work is forced to stop temporarily for the month of the February, due to the inclement weather. At 31st December 20X8, it is anticipated that there are a further 2 months of work before the building is complete. The requirement is what borrowing cost must be capitalized in the year ended 31st December 20X7 and 20X8. So you see, when you are calculating the 20X7, you have only 3 months, October, November, December. So you're going to take 350,000 multiply by the interest rate, which is 4%, multiply by 3 by 12 only. And then you need to deduct the investment income, which is 1,75,000 invested at 2.5% rate, and then again 3 by 12. So you deduct this amount and you get the figure for 20X7. And then you have the figure for 20X8. And it says building commences throughout the year, except for the February. So what are you going to do? 3,50,000, again multiply by 4% and multiply by 11 by 12, because you're not going to count the month of the February in which there was no construction, there was haltage, stoppage. And then you're going to deduct the investment income, 1,75,000 multiplied by 2.5%. Now it was invested till May. So January, February, March, April, but again, you're going to deduct the February month from it. So we are going to take only 3 months, which is January, March, and April, because it's first May. So it's the start of the month. You cannot take the May into account. So it's January, March, and April, 3 months. So you deduct this much amount and you get the amount to be capitalized. So for 20X7, 350 into 4% into 3 by 12, 175 into 2.5% into 3 by 12, you get the amount which is to be capitalized. In the second year, it continues the whole year except for the February. So you take 11 months and then 175,000, and you only take 3 months because we are not going to take into account the month of the February. All right, now we have another example. On 1st January 20X1, High Rise obtained planning permission to build a new office building. Construction commenced on 1st March 20X1. To help fund the cost of this building, a loan of 5 million was taken out from the bank on 1st April. Now you see, we cannot start the capitalization from 1st March because there was no loan on that date. The loan was taken on 1st April and construction has already started. So the relevant date should be 1st April. The interest rate on the loan was 10% per annum. The construction of the building ceased during the month of the July due to an expected shortage of the labor and materials. So you're not going to take into account the month of the July because the construction was halted in that period. By 31st December 2001, the building was not complete. The cost incurred to date were 12 million, excluding the interest on the loan. So this is the cost of the construction, plus we need to capitalize the borrowing cost as well. How that is calculated? 5 million into 10%. And then how many months? From 1st April to 31st December, but exclude the month of the July. So from April to December, there are 9 months, and you deduct the month of the July, it gives you 8 months. So this is the amount that is going to be capitalized. The last thing you need to understand regarding every standard are the disclosures. You just give it a read. IAS 23 requires the following disclosures: the value of the borrowing cost capitalized during the period, and the capitalization rate. No, in the notes of the financial statements, we are going to give these disclosures. So this is all about IAS 23 borrowing cost.